Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Show with Paul Sloate on forecasting the state of the real estate market for 2016. I'm Dan Breslin and host of the REI Diamond Show. I'm dedicated to helping you discover new ways to increase, multiply, and protect your net worth. Each week, I invite a high-caliber performer to share their unique experience as it relates to real estate investing. This week's guest is Paul Sloate. Paul is the founder and chief executive officer of Green Drake Advisors, a wealth management and investment management service provider to individuals, families, and high net worth clients located on the main line just outside of Philadelphia. Paul has appeared on several TV shows in the past to share his unique perspective on the capital markets and global economic conditions, and previously was the co-host of Money Matters TV for several years. So Paul, welcome to the show. Did I miss anything there in the introduction you'd like to mention?
I don't think you did, Dan. Well, thank you for your welcome. I'm happy to be here.
All right, glad to have you. So this is going to be a very unique direction for our listeners here, just so everybody's aware. You know, Paul is coming from a background where he has directed the investment capital at the most opportune times. He's been doing this for more than 30 years. So he's going to talk about things like the world economy, the general economy, a lot of higher level things that would impact the stuff that, you know, our listeners are definitely focused on, which is like single family houses, fixing and flipping, real estate values going up and down, you know, the volatility of the real estate market. So Paul, why don't you take it away?
Okay, so maybe we'll talk a little bit about the overall setting, this economic cycle, and then how it impacts the real estate cycle. So as we know, this cycle was very similar to what happened after 91-92. For those of us who remember back then, we had a housing bubble in the late 80s followed by a financial crisis in 91-92. This time we had a housing crisis in housing bubble in 05-06, followed by a financial crisis in really 2008-2009. So the setting has been very similar for real estate. If you go back to the late 80s, the big class that was effectively overbuilt at that time was office buildings, and residential real estate came along for the ride. And for those who thought that this downturn during this recession was unique, I remember apartments in New York City that were worth $250,000 to $300,000 in 1987, selling for about $100,000 in 1993. So no matter what our listeners think, real estate is highly cyclical, is subject to large periods of underinvestment and overinvestment, and these drive the economics of the asset class. So let's talk about what's gone on here in this cycle. As is typical after a financial crisis, you have to rebuild the financial system, which means lending is very tight and it's difficult to get credit initially, and that's what happened in real estate. So the cap rates were relatively high, and then what's happened is the Federal Reserve in this cycle has allowed money to be very inexpensive, which, as credit loosened up this cycle, has allowed cap rates to be driven down and the multiples on real estate to be driven up. The most important thing that the listeners should know about interest rates is that they are headed upward. And not only are they headed upward, but they're headed upward on a secular basis. And so let's talk about what this means and how our listeners should think about what this means for them. What this means is that about every 30 years or so, the overall direction of interest rates changes. So if you were to look at interest rates from, let's say, the 1940s to around 1980 for about a 35-year period, interest rates, while they went up and down, moved upward to new heights. Since 1980 to around 2011, interest rates moved downward within various cycles, but the general direction was downward. We're now at a period where, starting around 2011, 2012, interest rates are again going to move upward for a long period of time, as well as inflation. So real estate investors should keep both of those thoughts in the forefront of their mind, that interest rates over the long term are headed upward and that cap rates are going to go upward, and therefore the multiples on real estate are going to go downward. And in fact, we've seen some large transactions by well-known real estate professionals like Sam Zell, who just sold 23,000 apartments in a very large transaction to a public real estate investment trust because he felt it was time to start liquidating apartments. He's looking at long-term fundamentals for apartments, and he was also looking at the economic cycle as well as what interest rates are going to do over the next 5 to 10 years. So let's talk about interest rates in the short term a little bit. So if we talk about interest rates in the short term, we all know the Fed just raised interest rates and at the beginning of a tightening cycle. And typically what happens is, in a Fed tightening cycle, they begin tightening slowly, and then that accelerates over time until they ultimately cause a recession. In this case, the Fed will probably be a little bit behind the curve because they want wage rates to go up, and we can talk about that. There's a long discussion. There's been, over the last 15 years, a reallocation within the economy towards capital, away from labor. And it's kind of gotten to the political point where the Fed is interfering to move it back somewhat in the opposite direction, where wage rates will move upward and the returns on capital will move downward. So the most salient factor to keep in mind is that wage rates will move up, and they're also going to help force inflation upward, and they're going to force other things to occur in the economy. But the Fed's going to be a little behind the curve, which means inflation is going to pick up. And inflation has been significantly understated because of two things. Number one, the government statistics deliberately understate the inflation numbers. And number two, we've recently had a downturn in commodities, which has masked the underlying trend in inflation. So inflation, if we just look at the government numbers, is running around 1.8 to 2% if we took out the recent drop in oil prices. And with oil prices stabilizing, and even people like Saudi believing that the oil market will come back into balance, what you're going to have here is inflation should begin to march upward, and this underlying rate of around 2% as per the government numbers probably will show by the middle of 2016, which means that the Fed will, quote, be behind the curve, but they're going to deliberately be behind the curve. Also have to remember that 2016 is an election year, and typically what the Federal Reserve does is they will raise rates at the beginning of an election year, and they will raise rates at the end of an election year, but they don't raise rates in the middle of a presidential election. Historically, that just doesn't happen. So we can expect another rate rise probably from the Fed in March, and then for the Fed to resume raising rates sometime after the election next November. Likely, the other factor to keep in mind is because the Fed will have delayed, inflation will have picked up, employment will have picked up, which also will likely drive wage inflation higher. We're already seeing wage inflation across the board for all types of businesses, such that you're likely to see a faster pace of rate rises in 2017. And we believe we have as a base case, which your real estate investors should keep in mind, that the next recession will occur in 2018 plus or minus a year, whether it occurs in the second half of 2017 or 2019. We can't tell quite yet, but we're using 2018 as a base case for the next recession. And as we all know, during recessions, occupancies drop, lease rates drop, and other unpleasant things happen for real estate as an asset class. And we'll get into the individual pieces of real estate after that in a little while, but I want to talk a little bit about the next recession. For those of us who went through the last recession, the next recession is not going to be as bad. And the reason why is the financial system is well capitalized, which is important, which means the banks aren't going to be in danger of going out of business like they were in the last recession, where companies like Citibank and Bank of America needed to be rescued by the government. And so you're likely to have a typical garden variety recession with the typical drop in corporate profits of maybe 25%. So when we look at the next recession, it's likely to be modest compared to the last, and the rise in the rate of unemployment is likely to be lower than what people think it will be. So last time unemployment rose significantly because of the excesses that had occurred and because the financial system went broke. This time, unemployment is likely to rise less than it did last time. So coming out of the recession, exiting it, you're going to have a lower unemployment rate than you did exiting the last recession. And this is important because that means wage inflation will pick up sooner than later in the next recovery. In fact, we're projecting that after 2020, wage inflation and overall inflation in the economy is going to accelerate. There's a lot of factors that can impact that, but the majority of them that we see out on the horizon will cause inflation in the next cycle to be higher, which, by the way, will underpin higher interest rates throughout the economy. It will also underpin higher nominal growth for the economy because if you have higher inflation, you have higher nominal growth. Not necessarily real growth, but nominal growth is higher. And so if the economy was growing nominally this recovery at around 4%, maybe it grows next recovery at 5 to 6%. And that's important also to think about from revenues, from the type of debt you might want to take on, and how you structure the debt against the individual classes of real estate. The one other subject I'm going to mention is a little bit about what's going on outside the U.S., and thinking about how that has impacted the U.S. As we all know, over the last 15 years, the U.S. economy has grown much slower than it has over the prior 40 or 50 years. The principal reason for this was the entry of China into the World Trade Organization, where we went from something called the GATT, the General Agreement on Tariffs and Trade, to the World Trade Organization. That allowed China to grab big pieces of global market share, principally at the expense of the United States, and it really hurt U.S. growth. And in fact, the U.S. economy basically went from 25% of the global economy in 2000 to approximately 17% today, while China went from about 3% of the global economy to about 11% today. In other words, we handed China about 8% of the global economy, and that really hurt U.S. growth. I suspect that that's come to an end based on what I see as a budding political resistance to allowing the structure that has enabled this to occur to continue, as well as statements made by both sides in the presidential election. So it is also likely in the next recovery that U.S. growth will begin to accelerate as the U.S. addresses the overall issue of China and how much growth it will allow China to take from the U.S. I believe that we're going to be much more aggressive about this. I think there's a very big political push coming not just from Washington, but from the average American, as many polls have indicated. So that you should keep in mind. And there's one other piece of the international side you should keep in mind. The U.S. dollar has been driven up anywhere from 25 to 40% over the last 18 to 24 months against almost every currency in the world. This is really unsustainable for U.S. manufacturing. In the short term, it's going to harm manufacturing, but this will also probably be corrected under the next administration, as both sides in the presidential debate have addressed this, and it means you'll have a weaker dollar. You'll probably get a recovery in commodity prices. from where we are today just to make up for the weaker dollar. And you also see a recovery in U.S. manufacturing, which has been very hurt by the rise of the dollar against currencies across the rest of the world. This has happened twice before over the last 30 years. This happened actually over the last 40 years. It happened in the 80s under Ronald Reagan. Then in 1985, we had the Plaza Accord. And then in the late 90s, you had the Asian financial crisis. The Asian countries used that as an excuse to massively devalue their currencies ahead of entry into the WTO. And the U.S. dollar was driven up then. It was driven down under President Bush, and now it's been driven up again over the last couple of years. So that's just another exogenous factor that you should keep in mind, that the U.S. as an economy is likely to grow faster. There's likely to be rising trade friction with outside trading partners around the world. So let's talk a little bit about how all this is going to impact real estate. I think the first one to think about is that interest rates go up, cap rates are going to go up. That means the multiples on real estate are going to go down. So buildings today that are having cap rates, let's say, of 5% or so, will likely be looking at cap rates of maybe 6% or 7% out in a couple of years. So that's one thing to keep in mind. And the other big piece of this to keep in mind is that accelerating wage rates are going to allow rental prices to continue to rise, as well as housing prices to continue to rise. If you look at the ratio of mortgage payment to wages, what you find is that this has normalized after being depressed in 2011, when we were suggesting in the 2010-2011 that our clients accumulate significant amounts of real estate. At that time, the ratios, if you looked at the way rental pricing as well as housing was priced against those various asset classes, what you found is that the ratio as a percentage of wages that was being used to pay for those classes of assets by those who would occupy it was below average. And what's happened since then is that the housing has returned to the average rate, and we'll exclude certain cities like San Francisco or Los Angeles, where prices have gotten a little bit out of kilter with the underlying economics of the populace. But excluding those cities, what you have is that rental rates have gone above average, but housing rates are at average relative to people's income. So as people's incomes go up, it will support for sure housing prices continuing to appreciate over the next few years. And in fact, it's likely in the next recession that housing will do what it did in the late 90s, early 2000s recession, which was it will go sideways, because we have an undersupply of housing units now. We haven't been building enough after having massively oversupplied the market in the early to mid-2000s, which is what led to the collapse in housing prices, excluding any abuses that occurred because of the lending that was allowed to occur where people's incomes were not verified. So housing is likely to have only a minor pullback in the next recession. However, the rental market is likely to be more impacted. And the reason we say this is the following. The rental market sort of had what I would call a perfect storm of positive events drive the rental market for the last 5 years. The first was the normalization of the ownership of housing units in the country. So what happened is that we had way too many people owning real estate. And that occurred because the government put in place policies to encourage home ownership among those who really couldn't afford to live in their own houses. And as a result, we ended up with a lot of people getting mortgages who should never have gotten mortgages in the first place. And what happened is ultimately they all defaulted on their mortgages and had to move back into rental housing. And this accounts for about 5% of the rental units, 5% of the total housing units in the country moved from ownership of homes into rental housing as a percent of the population. So what you had was a huge shift from ownership to rental. So that's one thing that benefited rental housing. Secondly, the other thing that benefited rental housing was, if you look at the demographics, the millennials were entering the workforce in droves. And so what you have is a huge amount of 25 to 34-year-olds, which are the key demographic for rentals, sometimes down to 18-year-olds, but really 25 to 34-year-olds. And that demographic was growing at the fastest pace since when the baby boomers entered the marketplace. And in fact, you have to remember that the millennials are the baby boomers' children and represent a huge bulge in the demographics of the country. As a result, you had a large entry of new people into the workforce at the same time as you had a dearth of people entering into housing. So if you just looked at the demographics, you would expect demand for apartment units to go up significantly at the same time as demand for actual housing units went nowhere, because you had the millennials entering the years to live in apartments, while you also had people being forced out of houses. So this has retarded the housing recovery somewhat, while accentuating the apartment recovery. And as a result, now what we have in apartments is we are now building apartments, new apartment multifamily units, at a rate last seen in the 80s, which was when the baby boomers entered the workforce. So what you now have is the supply side has caught up to the demand side for rental housing. And the way we would look at it is rental housing now, on average, is above where it normally is in terms of rents as a percent of incomes, very similar to what happened in the 80s. What happened after the 80s was the 90s, where the rents relative to incomes regressed backwards. So I would expect that rental rates, real rental rates relative to incomes, are going to be under pressure as supply comes on. And then after 2020, you're going to have no net growth in the demographic of 18 to 34-year-olds. So there's going to be no net growth from 2020 to 2025 in the people who would naturally be apartment renters. In addition, the people who were forced out of their houses, that's over, and that's done with. And now what you have is, in fact, you have the home ownership rate stabilizing and has started to go up again at about 63.4% was the low recently, and it's now at 63.7% in the latest statistics. And the most important sub-statistic when we look at the demographic is that the millennials have started to buy houses. And we know this because we now have 2 quarters in a row where the percent of millennials have increased their home ownership rate. So what we're starting to see is millennials are acting just as generations before them. They get to their 30s and they start to, late 20s, but really 30s in this case, and start to buy houses. And so we expect coming out of the next recession, somewhere in that, 2019 to 2023, maybe 24 time frame, when you get a real recovery, is that you're going to see a significant rise in demand for home units over that time frame. It'll be very good for people who are building homes. So that is what we expect in terms of the balance between apartments and home building. So if we were making long-term allocations to capital here, we would look into buying maybe a home builder or getting into the home building area in the midst of the next recession where there's a lull in demand for houses, because that's the area that's going to grow significantly in the next recovery. And we would probably, like Sam Zell, be be exiting the apartment area to the extent we wanted, because that area is not going to increase in value as robustly. And in addition, we're going to have the pressure of rising interest rates over time, which are going to force multiples of our cash flow down as to what we could receive in capital for the multiples of our cash flow. There's a whole bunch of other classes of real estate which each have their own, what I would call, fundamentals here, and I'm going to talk briefly about each of those classes of real estate, and then I'm going to talk about how all this relates back to the economy and how this all interplays between what's going on in real estate and the economy, so that our viewers and listeners can hear how what's going on in real estate really becomes a microcosm of what's going on in the broader economy and really reflects what's going on in the broader economy. So we can talk about a couple of things. The most important thing to understand is that there has been really a dearth of supply in most of the other classes of real estate relative to history. So in other words, the percent increase in supply, whether it's hotels, whether it's office square footage, whether it's other types, industrial, self-storage, we have not built a lot of real estate in those areas, and thus the rents are pretty strong, as well as the supply-demand is very good. So let's talk a little bit about hotels. That's a class where while deliveries have started to accelerate in terms of hotel rooms, as we'll deliver over 200,000 hotel rooms this year, what you really have is you're not really growing the overall supply of hotels very fast. And as a result, the supply-demand has stayed pretty tight. We're going to see ADRs this year average, RevPAR, and ADRs are going to go up this year, occupancy's up this year, and your total RevPAR, that's revenue per available room, is going to rise around 6% for 2015. This rise should continue next year as the economy continues to grow. However, we would note in real terms, on an inflation-adjusted basis, RevPAR is back to the peak levels that we saw in the late 90s, in the late 80s, and so what you would expect, as we're beginning to see, is an acceleration in the expected number of rooms to be built. Now, most classes of real estate are in good shape. There is one class in the hotels that has a problem, and that area is that related to what I would call gateway cities that are dependent on tourism. And so those foreign tourism in particular, those cities are places like New York, where New York has a large portion of its hotel rooms that are a function of foreign tourism. And what's happened with the tremendous rise in the dollar, where the euro has gone from $1.45 to just $1.05, European tourism to New York City is way, way down. This is similar to what's occurring in other major cities that depend on foreign tourism, where the number of hotel visitors coming from outside the U.S. is way down and is impacting mid to luxury hotel rooms in those cities. What is not impacted in those cities is domestic travel by U.S. citizens traveling there for either tourism or business. So you have a small amount of oversupply that's occurred in those cities and is beginning to put some pressure on hotel rates, but outside of those specific instances, it's not an issue. So you have to be aware of that. And so that, assuming the next president, whether it's someone like Donald Trump or whether it's somebody like Hillary Clinton, addresses the U.S. dollar and the overvaluation of the dollar currently, which we estimate and other people estimate is 20 to 30% overvalued relative to other currencies, that assuming the next president fixes that dollar valuation, what will happen is these gateway cities will regain the tourism that they have lost from these international travelers. And given that in many cases you're not adding a lot of capacity, excluding New York City, those asset classes should come into balance again during the next recovery. So hotel looks pretty good. Supply is not out of hand. It's really controlled. So we would expect that to be okay. So if we were looking at the hotel class, if you had an opportunity to buy hotels during the next recession at a very, at good opportunistic purchases, because as we know, all real estate is local. No matter what anybody says, you can't pick up a real estate building and move it from one city to another. So if you have an opportunity to pick up an appropriate hotel property during the next recession, we would think that that would be an attractive type of asset to think about purchasing. So that's one thing. So that's the hotel lodging area. Let's talk about data centers for a little bit. As we all know, the internet continues to grow and retail sales continue to move to the internet. It's estimated that internet retail sales will be up 15% or more this year compared to actual physical store sales, which are not going to be up very much. And thus, all the incremental retail traffic is moving online. So if we look at that, what you've got for two classes of real estate that are really being impacted by this trend. One is data centers in a very positive way. Demand for data centers is growing significantly. Supply is growing at or below the growth rate in demand for these data centers. And in addition to this movement of retail from physical to data and basically big warehouses, and we'll talk about that in a minute, you also have the cloud, which is growing vociferously as you have large business as well as small business moving to the cloud for their IT. As a result, data center demand is being boosted from two major forces in the economy, which we expect to continue for the next 5 to 8 years in a very robust fashion. While the data centers will be impacted by recession, which we expect in 2018, plus or minus, we still believe that that's a very good asset class. And in the next recession, should there be, defaults because certain businesses go out of business and you have opportunities to invest in data centers opportunistically, this might be another asset class your viewers and listeners might want to consider for themselves. However, on the flip side of the data center positive is the malls, which is clearly a negative. As we know, mall sales were down this Christmas because of the shift of sales more and more to the internet, and that's going to hurt that class of asset on a long-term basis. Your A-class malls probably are viable over the long term because they can be transformed, maintain a certain amount of retail, which your typical consumer, when they buy something over the internet, if they're buying it from a store they know, they still like to return it at the store. So they have a physical idea of what the merchandise looks like, especially for clothing. So we expect that A-class malls will continue to have a place in the world where the economics work, and these malls are also restoring and reshaping what they've become to become more what I would call entertainment centers by adding significant amounts of restaurant and other types of space to the mall to help enhance the ROI for the owners of the mall. So if you're an A-class mall, you're probably okay in terms of the long term in surviving. We're not sure if the growth is going to be there the way it was there for the last 30 to 40 years because of the rise of the internet. We expect that what will happen as a result is that the mall owners will repurpose the malls at the A to be a split retail sort of entertainment, sort of restaurant type complex, which we see occurring elsewhere in the world. So your A-class malls probably survive as malls. and they will probably do okay, but not great over the next, 10 to 20 years as this transition to the internet plays out. The bigger issue is for the Class B and the Class C malls. In some cases, the economics just won't work, and these malls will ultimately be unable to support their debt. As a result, we expect these malls to close, be demolished, and actually repurposed into other types of real estate, whether they be multifamily, whether they be single family, whether it be warehouse, whether it be office, but we expect those B and C malls ultimately to be under a lot of economic pressure, especially the C malls. We see it very hard for them to survive over the next 10 years. So the idea with the C malls would be to buy the real estate for the value of the raw ground and to repurpose it to another purpose. And that's kind of how we see that playing out in the mall space. So you have a bifurcated result where your top quality malls, such as Mall of America in Minnesota and the King of Prussia Mall in Pennsylvania, they will do fine as A-quality malls and transforming themselves into entertainment/retail centers, while B and C malls are going to be under significant pressure. So that's data centers and malls and hotels. We have industrial real estate, which has not been overbuilt. It's a massive beneficiary of the shift to the internet because we need many more what I would call pick-and-place warehouses, which are these large automated warehouses where goods are automatically packaged and shipped to the consumer, whether they're built by, Amazon or Walmart or any other major retailer. These big warehouses are doing quite well. And in addition, they're going to benefit from the opening of the Panama Canal, which is going to move goods that were previously delivered to the West Coast and put on a train to move them east to the East Coast, where the goods will be delivered directly. So those warehouses should be good, especially in those areas that will benefit from the opening of the Panama Canal and the continued growth of the internet. So we expect warehouse industrial to do well. The only thing with industrial you have to be aware of is it's very cyclical to the economy. So industrial real estate basically follows manufacturing. Manufacturing is currently in a small recession because of the rise of the dollar. While the supply demand is okay, you have had a little bit of pressure on manufacturing. You'll probably get a bump next year because of the highway bill that was just passed by Congress, which will help non-residential construction and will help the companies that are tied to it and make, let's say, road paving equipment or involved in crushed stone or other things that are going to be involved with the highway bill. However, the industrial economy ultimately will have a difficult time during the next recession, especially with a higher dollar. So we expect there to be some pressure on industrial real estate during the next recession, but if the dollar value gets fixed and this turn to the internet continues as we expect, then industrial real estate should continue to do fine as an asset class and continue to grow. Now, I do want to mention one last thing that's important for real estate owners to know about if they missed it, which was under the Protecting Americans from Tax Hikes Act of 2015, which was signed into law on December 18th, it has allowed foreigners to increase their investment in U.S. real estate. So foreign investors are now allowed to increase their ownership of publicly traded REITs to 10% without being subject to taxes up from 5% prior. And the other piece is non-U.S. pension funds have been completely exempted from this tax that would be imposed on them. So what that will allow is for them to take full ownership and accelerate their asset purchases in the U.S. We would note that foreign investment into U.S. real estate is up over 100% in 2015 and represents almost 18% of all the real estate deal volume this year, which is running at almost $500 billion. So if you think about it, foreign investors have increased their investment into U.S. real estate from about $50 billion in 2014 to over $100 billion this year. And with this loosening, we would expect this to increase again next year because it allows them to take a much bigger stake in U.S. real estate than they were prior allowed to do. So if we were to look at all this for the real estate investor, there's some very good opportunities ahead for the real estate investor as the economy moves forward. Now is probably a good time to liquidate properties you don't want to hold through the next recession, as the next recession is coming up in just a couple of years, and closing real estate transactions can take time because it's a sticky asset, and there's lots of money available to buy. And one of the pearls of wisdom we know from having invested for years and years and years is that when the sun's out, go get a suntan. And by that, what we mean is if people are out trying to buy properties at big prices, you want to be a seller. And if people are out trying to sell properties at very depressed prices, you want to be a buyer. So if we go back to 2010, 2011, we were recommending to our clients to accumulate real estate assets. And as in retrospect, it turned out to be a very good time to purchase real estate assets. Now, 5 years later, we're recommending that our real estate owners liquidate those parcels of real estate that they do not want to hold through the next recession and come out the other side with. Now, there may be tax reasons why you don't want to sell a building or other types of things that might drive the decision to hold on a piece of property, such as development that's going to increase the value of the property regardless over a 5-year time horizon, such as adjacent pieces of property being developed that enhance the value of the piece of property you own. However, today there's a lot of money out there looking for properties they're willing to buy at very low cap rates, and it's easy to sell properties because banks are willing to lend. As we all know, in recessions, the money's not flowing for people to buy properties. Banks don't like to lend because their non-performing assets are going up, and so they cut back on their commercial real estate lending. So not only is it harder to find people who want to buy properties, but the banks don't want to give you money, and they're going to require better ratios at a time when the cash flow from the property is likely going to be down. So if the one piece of advice I'd give your listeners today is if there are properties they want to sell, sell them now and start accumulating cash to deploy during the next recession. Because those who have cash are able to deploy and buy assets opportunistically, and those who don't can't, because the banks won't be there to lend you gobs and gobs of money at that time. I think that kind of covers the various classes of real estate and how we look at them and how we're looking at them on a multi-year period for our clients. The only thing I'd add is that real estate's a very important part of the overall economy, and its contribution to economic growth is very important. And so what we've had going on this economic cycle is we've had lower growth in real estate assets as a class because we've had lower economic growth. And thus it's been what I would call a negative feedback loop relative to the economy, in that because we've had lower growth in real estate assets, which has fed into lower growth for the economy. What I think will happen in the next recovery at least what the data is telling us, is that we're going to have higher economic growth. That's going to lead to higher demand for real estate assets, which will feed back into higher growth for the economy. So it becomes a positive feedback loop, unlike the negative feedback loop we've had this economic cycle around. So I would expect that in the next cycle, you'll be able to fill up your properties at a faster rate than you've had this time, and that the recovery to earning economic returns on any asset will be a shorter time frame. And with that, Dan, I'd like to turn it back to you for any last questions you might have on either the economy, real estate, or any other subject you'd like me to cover today.
Well, that was some powerful information, Paul, and some of the things you were talking about kind of triggered some thoughts in my mind. And I've been thinking about this for a little while. Maybe you could kind of help me get some clarification on this. You talked about interest rates going on a perhaps 30-year or 35 or even 40-year cycle of increases over potentially, we're at the beginning of that now. Do you believe that would end up at a place like we had experienced back in the late 70s, where we had double-digit interest rates at some point in the future, or is that unrealistic?
Well, I think it's way too hard to know. And the reason I say that is the reason we ended up with the inflation we had in the 70s was a combination of going off the gold standard under President Nixon, coupled with some policy errors by the Federal Reserve at that time. And so that's really what caused inflation to explode in the 1970s. So that's one thing. It's hard to know if we'll get there, but I certainly think we're going to get back to 1960s style inflation, which was sort of maybe 4%, right? 5%. Remember, we had sort of 4% or so inflation. And we'll get there gradually. Nothing occurs overnight. It takes a long time from where we were to getting to 4% inflation as an underlying inflation rate, but I think we're headed in that direction. Is that helpful, Dan?
Absolutely. And one of the other questions that kind of ties into that a little bit, let's take an example, and I know I'm coming from a point of slight ignorance here, but in the 70s or in the 60s or even coming into the 80s, we had an economy that, say, General Motors, and the amount of capital required for a company like a General Motors to produce their dollars of profit and their return was significant in comparison to some like Google or an Uber, where it's a more idea and information driven and less capital-intensive business on the front end. And I'm just speculating to think, would that, as a longer-term trend in the overall economy, would that have any impact in keeping interest rates relatively lower than perhaps it had been historically, or is that just an incorrect assumption on my part?
Well, here's what we know historically. Firstly, the way I would think about places like Google, right, because Google's a big search engine, and it really makes its money by advertising, right? Pay-per-click or whatever, however, right? But it's really that analytics, right, that it makes its money on, which is very similar to what the advertising industry is structured, right? What we have done as a country is made a choice to decrease manufacturing and grow other areas such as healthcare over the last 15 years or so, 15, 20 years, okay? What I suspect is that we're going to be increasing manufacturing over the next 15 years as a percent of the economy, and we've been underinvesting in the United States as an economy from an investment standpoint of just CapEx for the last 15 years, since China entered the WTO, as effectively multinationals outsource production to China. As I indicated, I think that trend is over, and it's not going to be allowed to continue. I think the political forces are sort of in place to reverse that and actually bring production back to the U.S. So I think that you are correct. You have new businesses like Google that are not capital intensive, but they effectively displace businesses like the advertising agencies on Madison Avenue, okay, in terms of their economic impact. And the other thing to think about is if you look at Amazon, okay, so let's take a look at Amazon, another one of the internet darlings. Amazon's return on invested capital, as it's grown, has absolutely collapsed because it's been investing so highly and not earning any money on the investment. So if we break Amazon's business into two pieces, the cloud business, where it's now facing a real challenge from Microsoft and Google, so it'll have to continue to invest there, and then the retail business, where if you look at the retail business, Amazon doesn't make any money. It has to invest at such a rapid rate it makes no money, and its overall return on capital is actually in the mid-single digits. It's actually very poor for a major corporation. So I think maybe not, but the history of corporate America is periods of earning very high returns on capital followed by earning very low returns on capital. Okay, Dan? Is that helpful?
Absolutely. Absolutely.
Okay. Is there anything else I can answer for you?
I'd wonder if in the 2000 to 2007 era, we had an abundant source of capital coming from the commercial mortgage-backed securities, Wall Street, those lending criteria. And that allowed for that humongous downfall when that tightened. Can you speculate as to the tightening, perhaps in real estate, as to where those sources of capital are coming from right now? Where would be the loose money sources in real estate?
Well, I think the loose money has gone definitely into commercial real estate. Here's what I say. The big difference is, if you go back, so this is where sort of having seen these things before, okay? So if I went back to the late 1980s, I saw a lot of financial shenanigans being done in the financial markets. And I had people try to sell me pieces of paper I knew weren't worth what they were being claimed to be worth, which ultimately proved true in the 91-92 recession. In fact, a lot of the junk paper then, if you looked at it and what people were trying to float and you ran the numbers from the companies, they couldn't pay the interest and they couldn't cover the debt. Okay? And that was very similar to what happened in sort of the mid-'80s where they couldn't pay the interest. They really couldn't pay the debt. As well as what happened both in the late 80s and in the mid-2000s is then people took these, what I would call fundamental pieces of paper, and then they sliced and diced them into and shoved them into new pieces of paper. So what you did is effectively you built a house with a shaky foundation, and once that foundation fell out, the whole house of cards collapsed on top of it. So I don't see that going on now. The Federal Reserve has been all over this and not allowed that to occur this recovery. So I think you're going to get a normal downturn in what I would call non-performing assets. Does that make any sense? Now, there are going to be some pockets that are going to have problems. Like if you're in Houston, you've got a problem, right? Because if we were to take the energy downturn and then add to the energy downturn what I would call a normal recession, that's going to be a problem for financial institutions that are lending in Houston or lending in energy areas. Okay, is that helpful, Dan?
Absolutely. Do you think that the foreign investment as a source of capital and being 18% of the deal volume, do you think that could change, or there's any indicators that could evaporate and leave a gap in, the amount of investable capital in those source investment classes?
Well, here's the thing, that foreign capital, like most capital, tends to be pro-cyclical. So when things go to hell in a handbasket, basically the capital disappears.
Got it.
And I've seen this over too many cycles to know. And here's the other thing. The history of foreign investment into U.S. real estate is the history of foreigners coming in with big money near the top of the market.
Like right now?
Like right now. Or coming in as they did in the late 80s. Remember when the Japanese were going to own all of the U.S. real estate? So they bought real estate at very inflated prices. In fact, they bought Rockefeller Center, and then they sold it back to U.S. people a number of years later at a value much below what they purchased it at.
Well, history does repeat itself.
That not only does the real estate drop in value in U.S. dollars, but maybe the U.S. dollar drops in value relative to foreign currencies. That's not a good outcome for international investors.
So, Paul, I, like our listeners, are coming primarily from a real estate investment background, and you brought a great perspective. I have a ton of information here in like 5-6 pages of notes. Would you have any book recommendations for someone like me who could gain some more knowledge in the fundamental or the economic fundamentals and tying that into the real estate so that we can maybe build our own perspective just like you shared with us today?
Well, I think there's a lot of really good books on, investing. I think a lot of what I've done here in terms of bringing economic perspective to real estate is just bringing a general knowledge of economics. And there's a lot of good books on economics out there, and I would recommend your listeners can look into those. But if they want to start with a book on investing and how, we think about investing and approaching investing in asset classes for our investors, we would recommend reading The Intelligent Investor by Ben Graham, and not reading a version which has commentary by some of the modern investors, but buying a reprint of maybe one of the versions that was written by Ben Graham without any alteration. So you can buy some, I think the last edition he wrote was back in the 70s, and you can buy one of those editions and read what he has to say. Because even though it was written really originally back in the 50s and then updated through the 70s, that book is timeless when it comes to investing and to thinking about investing and making investments. He focuses on common stocks and bonds, but you can generalize what he says to any class of assets. And really, what it comes down to is you really have to know what you're doing, and you have to understand what drives the assets that you're investing in. So if I were to recommend one book, I would recommend that book. I read that years ago, over 30 years ago, and I still think it's one of the best written investment books out there, and it's timeless. And it doesn't matter whether you're somebody who's beginning to invest in real estate or somebody who's been investing for 30 or more years, it will help you to think better about your real estate investment.
And Paul, wasn't this the same Ben Graham that was somebody's mentor in the stock world?
Yes, that is the same mentor as the mentor for Warren Buffett. He's truly a brilliant investor, and, of all the people I've followed over many, many years, I think Ben Graham, who is really responsible for Warren Buffett's success, has not gotten the type of publicity and thought that he should.
Do you have any other final jewels of wisdom to share with our listeners, Paul?
Any jewels of wisdom? The only jewels of wisdom I would add to your investors and listeners who are very knowledgeable in the real estate area is that, having done investment and allocated assets across multiple asset classes for many, many years, it's always best to buy when the world is coming to an end. And it's always best to sell when everyone wants to be invested in the asset class. And that would be my final suggestion.
So simple, yet so difficult to do for so many, to go the opposite direction of the crowd. Right, Paul?
That is. It's all about investing when the crowd's not investing.
So, Paul, if anybody is listening and wants to get some more information about you or your company, do you have some contact information you'd like me to share and include with the show notes?
Sure. They can contact us. They can call us. We're located here in the Philadelphia suburbs. They can contact us at 610-687-7766, and they can ask for me, and either I or my assistant will get back to them and schedule a time for us to speak. Or they can go to our website and look at us at www.greendrakeadvisors.com. Or they can write to us, and our mailing address is 175 Stratford Avenue, Suite 1, Wayne, PA 19087. I think that would be the best ways to get a hold of us.
All right. Well, Paul, I really appreciate you coming on the show. You've shared some great knowledge, and I have quite a solid perspective written down here for the real estate market. Thanks for coming on the show.
And thank you for having me. I hope it's of value to your listeners.
All right. And thank you all for listening to this episode of the REI Diamond Show. Did you enjoy this episode? Do you know anyone else who would enjoy this episode? Send them the link to the show and tell them to sign up and receive an email update of new weekly episodes at www.reidiamonds.com. And I'll even send you my special report titled 7 Sources of Off-Market Deals. That website again is www.reidiamonds.com. Until next time, this is Dan Breslin signing off.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.